All right, welcome everyone. Good to see some familiar faces here. Oh, there we go. Welcome everyone. Good to see some familiar faces here. Happy to do a presentation all about reverse mortgages and try to give everyone a little bit more information about how reverse mortgages can be utilized, some of the creative ways of using it, of course, how the majority of individuals use it, and also dispel some of the myths and feelings that people have around reverse mortgages. So thanks for coming to the presentation today. I'll talk about the basics of reverse mortgages, typical uses, creative uses, and then I'll go into a little bit more of the basics just to reinforce those fundamentals again in a different way. Talk about some of the myths and facts. Talk about options to finance, how your home equity over time will look if you do get a reverse mortgage, because that's one of the concerns, of course, of getting a reverse mortgage is your home equity erodes over time. I'll go through a couple of examples, and then I'll make sure that we have lots of time for Q&A as well, so we can answer any questions. So first of all, what is a reverse mortgage? It is a loan secured against the value of your home. It's designed exclusively for Canadian homeowners that are aged 55 and older, and it provides access to up to 55% of your home value. One of the cool things is that the money is all tax-free, so there's no impact to government pensions, no impact to taxable income or anything like that. And probably the biggest feature is that no monthly mortgage payments are required, and you maintain ownership and control of the home. So what we find is the easiest way to explain what a reverse mortgage is that a typical mortgage, you get a mortgage, and then you're working on paying down and paying off that mortgage over time. A reverse mortgage actually is where you have a mortgage balance that starts at a certain amount, and then the balance is increasing over a period of time. And that's because you're not making a payment. So the interest cost gets added to the outstanding balance in every single payment. Whereas if you have a regular standard mortgage, what you're doing is you're paying the principal and the interest, and so you're paying down the mortgage. So reverse mortgage just means that it's basically going up in value over time. And this is why some people can be concerned about reverse mortgages is that, oh, well, what happens to my equity as it goes up? And that's one of the reasons actually that the reverse mortgages are designed for people that are aged 55 or older. And the reason for that is they want to make sure that there's always enough equity in the home over time. And so trust me, the lenders do not want to get in a position where the value of the home is here and that the reverse mortgage actually eclipses it over time. And so what they do is they make sure that they're only lending up to a maximum of 55% of the value of the home. And typically that maximum value is determined by your age and the location of the asset and their expected appreciation of your home. And they're always making sure that in general, they're going up and lending more money, a higher percentage of the value to those that are actually older. And it might sound a little bit odd to say this, but it just means that there's a shorter life expectancy for those individuals, which means that there's less time for those loans to increase and add up over time. So a couple of the typical use cases that we see, a reverse mortgage can be used to provide additional cash flow, and I'll give an example of that later on in the presentation. It's not just about presenting and giving you a large cash sum to either purchase a property or refinance and pay off debt or do debt consolidation, but you can actually do with some of the lenders a increase to your cash flow, so you can actually have something where it is giving you an income on a monthly basis. It helps individuals stay in their homes. So a lot of the time people come up to a situation where they either have to decide to sell the home in order to pay off debts or to get their expenses under control, or get a reverse mortgage in order to be able to stay in the home and give them that cash flow or cash that they need in order to maintain that ownership. Another interesting thing is that a normal use case here is just providing an alternative method of qualifying for the mortgage. And that's because the income is not a factor. We do find that that especially in major urban centers like Vancouver and Toronto, the home values are very, very high. And when somebody has a mortgage going into retirement, their income drops in retirement, and it's harder to afford that mortgage, and it's also harder to qualify for that mortgage. So we do find that being able to provide an alternative option to be able to finance that property is a really good option as well. It just allows you to qualify based on the value of the home and the amount of equity in it, along with your age. And so they don't actually even look at the income at all to determine whether you qualify for this. So it's almost like an equity lending mortgage, which doesn't really exist in the mortgage space other than with private lenders right now. And so it's a way of kind of getting around the challenges often with being able to qualify for a traditional mortgage. So let's talk a little bit about the creative uses, because I really like some of these really unique ways of being able to use a private or a reverse mortgage in order to be able to qualify and also to increase your wealth over time too. And so one of the cool things is investing in real estate. So I'm going to try to explain this, and then if people have questions, we can make sure to address this. But you can actually use a reverse mortgage to invest in real estate. So you could get a reverse mortgage on your home, use that cash to buy a rental property. There are no payments on the reverse mortgage, but you're earning cash flow on the rental property. So you take out money out of your home, take the equity out, buy a rental property. That rental property produces an income for you. You're earning cash flow on that rental property now. And on top of that, you earn and get appreciation on the value of the rental over time too. Now, probably the coolest thing about this is that even though you are not making a payment on the reverse mortgage, so you don't have to pay out of pocket, you actually still get to write off the interest amount that accumulates on that reverse mortgage. So if each year there's $50,000 of interest that is accumulating on the reverse mortgage every year, you're able to write off that $50,000 on your taxes and write it off against the rental property income. And so even though you're not actually having to pay these payments, you still actually get to claim it as a tax deduction. So it's a very cool way of being able to reduce taxable income, but still create an income for yourself into retirement. So I really like this strategy, and I don't think it is a very common strategy, but for our clients that are real estate investors or wanting to figure out how to create an income for themselves in retirement, this is a great way because you don't have to qualify for the mortgage based on the traditional methods. So it's not based on your income. It does create an income for you. And now you own not only just the home, but you also own another asset that is putting money in your pocket. And I do have an example that I'll show a little bit later that kind of goes into a bit more of the numbers and details on that. Another very common use that we see that's a bit more creative is it's very difficult for younger people to get into the real estate market in a lot of urban centers in Canada. And so we're finding that a lot of people and families want to help their children, but in order to help them and give them a gift, because they have a lot of equity in their home, they would have to qualify for a mortgage, and then they would have to have payments on that. Neither them or their children can afford those payments. However, they might have a home that's worth $2 million that eventually is going to be inherited by the kids. But you don't want to wait until the kids are, 60 and the parents have passed. Do the kids really need the inheritance when they're 60 years old, or do they need it when they're 40 and they're trying to buy their first home? So one of the creative uses here is an early inheritance strategy where the parents would get a reverse mortgage on their home, and then they would gift the money from the reverse mortgage down to the kids. And the reality is, it means that the kids get the money now so they can go buy their own home and start to get their life going. And yes, it's going to mean that over time, their inheritance that they will eventually get in the future on that home is slowly being eroded because the reverse mortgage is slowly growing and eating into that equity in the home. However, at the same time, the equity is growing in the home that the kids could now buy and could qualify and be able to afford because they're getting a kickstart into being able to buy their own home quicker. And so it's just a way of being able to provide a gift, and there's no payment, so nobody has to make any payment. And yes, it might be eroding the home equity, but that's the home equity to be going to the kids. But at the same time, too, they now get to buy something themselves and get into the market a little bit sooner. So I really like that strategy as well as an early inheritance, kind of a gift strategy to get or make that transfer of wealth happen a little bit earlier than upon passing away. And this one I've kind of already alluded to, but it's equity lending. And equity lending with most major banks has disappeared. And they're only really looking at the age and property, so location, type, and the amount used in the underwriting to determine how much you qualify for. And that's something that you typically only see private lenders offer. And of course, private lending rates are much higher. So it's something we definitely want to keep in mind, is that it is a way of being able to qualify without the traditional means of qualifying based on an income. So one of the things that I had previously, I had a guest speaker speak on this last year, and actually kept their slides in here. So Chip is one of the lenders that we do deal with. It's Home Equity Bank, and what they did is they went through a number of slides and gave us an idea of some of the things that are important in some of the cases that they've showed. And I wanted to keep these slides in here because they're a little bit more informative than mine, and they had a lot of detail. And I figured, why recreate the wheel if they already have all the information and detail already created? So I'll walk you through some of this information. Home Equity Bank and Chip reverse mortgages, they're not the only lender in town. There's a number of lenders that are available, and so we'll go through this example, but it can just keep in mind that there are other options available to you, and we're able to shop that around and figure out which lender is a better rate, can give you more money, et cetera, et cetera. But let me walk you through this and go over some details. Now, some of this is going to overlap a little bit with the details I've already gone over, but as I mentioned before, payment optional. So, and that's an important distinction. You don't have to make a payment, but you still can make a payment if you choose to. So no payments are required as long as one applicant is living in the home. They have limited credit and income requirements and no medical check. And you can unlock up to 55% of the value of the home in cash, and that depends on the age and the property. So that's, again, how they determine how much money you can get. The funds can be advanced as needed, with interest only accruing on what's been advanced. So it's almost like a line of credit. You can get an approval for more money than you actually need, but then you can take out a certain amount and you only have interest accruing on the amount that you've actually borrowed. Another distinction is that the proceeds are tax-free, and penalties on the mortgage are waived at death. So most lenders, you'll find that they have a penalty if you break the mortgage early. And often I will say that the penalties for reverse mortgages are usually more expensive than traditional mortgages in the first couple of years. Then the penalties usually are dropped in half if somebody's moving into a home, like a care home, and they are waived if somebody's passing away. I know there's a question about can you get a reverse mortgage in a lump sum or only in monthly payments? You can actually do it in both, and I'll be going through an example where you can get a reverse mortgage amount in a lump sum, or you can do it in payments. You can also do both, so you can get a lump sum and a monthly payment as well, depending on the situation. So that's the basics, but a couple of nuances that I wanted to go over. Let's talk about some of the myths and some of the facts. And so one of the common myths that comes up is the bank owns my home. The bank doesn't own your home any more than they do if it's a regular mortgage on the property. It may feel like it because, of course, they have a charge on the title that's going to increase over time, but the bank does not own your own home. You still have the control over being able to sell the home whenever you choose to. It is just like any other traditional mortgage from a legal perspective as far as what controls they have over the title or over the property. And the second myth that comes up quite a bit is that the bank can force the homeowner to sell or to foreclose, and that is not true either. I actually tried to dig into this to figure out where this myth came from, and apparently, I think it was in the 80s and 90s, there were some companies, some reverse mortgage companies in the United States that were running around giving everybody really, really large reverse mortgages, and then those mortgages were going underwater, and then they were foreclosing and forcing the homeowner to sell. And so this myth is rooted in some fact. In Canada, it's never been that way, and even in the U.S., there's now regulations that restrict that. So I think before there actually weren't any regulations on reverse mortgages, and now there of course are. And nobody wanted to see people get kicked out on the street. The third myth here is that upon the eventual sale of the home, I or my beneficiaries will owe more than the house is worth. So just to address this concern, what the reverse mortgages, what the lenders do actually is, even if the reverse mortgage actually exceeds the value of the home, the reverse mortgage lender will eat that expense. They'll eat that cost. And so there is no risk to the homeowner that the outstanding mortgage balances actually exceed the home value. And that's why they're relatively conservative with the amount of money that they'll lend to you, to ensure that they're fairly comfortable that the reverse mortgage amount will not exceed the home value, because the home is appreciating at a certain percentage every year. And in general, they're usually looking at that and thinking that, yes, we're probably going to be able to outpace the amount of the interest accumulating on the mortgage. with the value of the home increasing. So the question here, main, is do you need to own the home 100% to get a reverse mortgage? All applicants need to own the home 100% in order to be able to qualify. And each applicant needs to be under or over the age of 55. So if you have one applicant that's 60 and one applicant that's 50, then you would not qualify for a reverse mortgage. Both applicants need to be 55 or older, because it's always the youngest applicant that's going to outlive and hold this mortgage in perpetuity. So yeah, all applicants do need to own the home 100% in order to qualify, and the youngest person on the title needs to be over 55. Last and not least here, reverse mortgages are a lender of last resort and should never be trusted. That's not true. It is a useful tool when used properly, and I do talk a little bit about the pros and the cons of reverse mortgages, because reverse mortgages are not always the best. They are in general a slightly higher interest rate. And of course, for those that can't afford to make payments, it doesn't necessarily make sense to get into a product where if you can't afford the payments, you're just choosing not to, but paying a higher interest rate, it will overall erode your net worth more than just a traditional mortgage would. So it really depends on the circumstances and whatnot. So for me, if you have a HELOC, the reverse mortgages must take first charge, and so they have to be in first position, and they don't want any other financing on the title. So if you do have a HELOC on the title, then this will replace whatever charge you have on the title, and it will remove that. So you can't have a reverse mortgage and another financial charge on the title of the property. They won't allow that. Okay, so let's talk about the options here, because there are a couple of different ways and routes that you can take when you're trying to figure out which route is the best for you. And again, different lenders have different products, but I'm using CHIP here because it gives you a pretty good idea of the different options here. So a CHIP reverse mortgage is the most popular product, and it's ideal for those that are looking for one-time lump sum. Usually it's good for paying off debt, good for renovations, or some kind of large expense like a health situation or a car or whatnot. So that's the most common uses for their standard reverse mortgage. The CHIP Max, what it does is it provides a loan amount that's higher than a regular CHIP reverse mortgage. And this is usually to avoid high interest loans or an additional mortgage. It also is a way of boosting the income, which we'll get to in a second through the Income Advantage product, and for loans consolidation. The difference between the Max and the standard reverse mortgage is just that the CHIP Max will give you a bit more money, but it's a little bit higher on the cost, on the interest rate, and so it's not always the best option. It just depends on the circumstances. The Income Advantage is really cool. So it can create a supplemental income for you. So you actually get monthly advances in addition to a one-time lump sum. And so it allows you to boost your day-to-day lifestyle, increases your monthly cash flow, and it's a way of protecting your investments, because a lot of people eventually may get to a point where they have to make a decision. I either have to start to draw on my investments and start to lower those investments down, or have to find another way of boosting my income or lowering my expenses. And one of the ways to do this and stay in the home is you may be able to stay in the home, and in order to supplement your income so that you can remain there, you instead get a Income Advantage type of arrangement. So why get a reverse mortgage instead of a HELOC? I'm going to actually answer that in a little while. So one of my last slides of the presentation, I will talk about the difference, because a HELOC is a very, very similar product in many ways. In particular, one or two different banks have products that are a good solution to a reverse mortgage, or very comparable, I should say. And then the last option here is a CHIP Open. So it's a short-term solution for those that are willing to pay a higher interest rate and a closing fee in lieu of prepayment penalties. And so this is very commonly used for bridge financing or short-term cash flow solution. So let's say that you own a home right now and you're buying a new home. Maybe you're downsizing and buying a new property, and you haven't sold your existing home yet. You could get an open mortgage through CHIP. And they do charge a fee and a higher interest rate for this, but it would be a way of being able to own both properties. And so instead of using a private lender for this, you could use a CHIP Open mortgage instead. And then once you've sold the existing home, you have the flexibility to look at converting it into a better long-term solution if you want to continue to be borrowing money in the future. What I do find is, especially at an older age, a lot of people are looking at this and thinking, you know what, I really don't want to have to move everything on one day, in one day. It makes it a lot easier, even if it comes at a bit of a cost, to be able to buy the new home and then do a slow move everything into the new home, and then get the current home prepared and ready, especially if there's a lot of stuff. I do find, especially when downsizing, if people have lived in a home for 40 or 50 years, they accumulate a lot of stuff. So it makes it a lot easier to make that move nice and simple. And of course, again, the higher rate and the fees applicable make that more expensive, but it may be better for the lifestyle. So there's a couple of examples I'm going to start to go through here and give people an idea of how this might work. So there was a 72-year-old couple that had a $600,000 older condo in Coquitlam, and they weren't really happy living in the property. There's a lot of costly repairs and whatnot coming up all the time. They didn't really want to move into a retirement home, but they did want to look at buying a new condo, so something that needed a little less work, but on minimal income, they couldn't qualify for a traditional mortgage, nor afford the payments. So what they did is they used a chip mortgage to purchase a new $900,000 condo. They got a reverse mortgage of $343,000. So that was basically the amount that they needed after they sold their condo, paid the closing costs, paid a realtor, and paid for the closing costs in the new purchase. And then they'd have a reverse mortgage on their property. So purchasing for $900,000 and a reverse mortgage for $343,000. So allowed them to buy something a little bit more expensive and a bit nicer. And then avoid the pain and issues of living in something that's used and needing renovations. Another example here on their income supplement side. So Miss Holland is 72 years old and was struggling with balancing her monthly cash flows every month because of inflation, and her expenses had gone up quite a bit, and her pension and old age security just weren't cutting it anymore. And so instead of getting really stressed out and trying not to put this money on the credit card debt, etc., she thought that she had to sell the home, but moving would mean leaving the community and the neighborhood that she'd been living there for decades. So the good news is that the home had increased quite a bit, and it appraised at 1.2 million, and she was able to access some of the home equity up front to pay off some of her debts, and then receive a tax-free income of $1,200 per month to cover the balance of her negative cash flows and a little bit of extra money for her in retirement. And so instead of her having to sell and then take that cash and then put it into an investment of some kind of sort, instead she decided to just stay in the home and then get an income advantage mortgage, reverse mortgage, that then provided an income to her on a monthly basis. And so one of the examples here is that in this case, she received a $25,000 lump sum right away. And so you can see that right here, $25,000 lump sum. And then what she was receiving is every year she was receiving an extra $1,200 per month, which is $14,400. So you can see that the reverse mortgage basically had increased by $14,400 every single year. And you also need to make sure that you're including how much interest has accrued on the outstanding balance. So these were the interest rates, and these were interest rates as of last year, which are about the same as they were last year when we did this. I think their rates are slightly higher as of today. And so you're going to notice, by the way, that the reverse mortgage interest rates are about 2% higher than the standard mortgage rate in general. So the annual interest that accrues continues to add on, and so you can see that the outstanding balance after the first 12 months was the $25,000 she took out as the first lump sum, plus $14,400. That's 12 monthly payments of $1,200 a month, and then plus the interest that accrued on that amount, which is $2,842, and so she owes $42,000 at the end of that first year. And over time, that trend continues and continues until over time, in year 10, she's received in total $169,000. The total interest that is accrued on this adds up, and in total, she would owe $289,000 on the reverse mortgage. Now, that being said, in general, home values tend to increase in value, and so you can use a number of different calculations. In this calculation, they're using a 4% annual appreciation. I might use maybe an annual appreciation of 3%, so maybe a little bit more conservative than what they used in their example. However, the home value would go from $1.2 million up to $1.76 million. And so interestingly, by being able to stay in the home and receiving an income, the home value and the amount of total equity in the home has actually gone up from 1.175. In fact, it started at 1.2 because remember she owned it free and clear with no mortgage on it. And so it's slowly, even with the reverse mortgage going up, you can see that every single year her remaining home equity is still actually increasing. And there would be a point at some time that this would actually start to flip and the home equity amount would start to decrease. It wouldn't continue to increase and continue to grow. But you can see that in this example, the home value is actually continuing to still go up, not go down. So there's a question about how often are interest rates recalculated. It depends on the term. So like a regular mortgage, you can take a 1-year term, 2-year term, 3-year term, 5-year term, et cetera. And so it depends on the term that you choose. And then rates and pricing for that are really similar to standard mortgage rates. In general, most of the time, shorter term rates are usually lower than longer term rates. However, in this climate, it's the opposite, where shorter term rates are a bit more expensive than the longer term rates. And there's a question, as the home appreciates, does the max loan amount get adjusted so it stays at 55% of the current market value? So no, they would lend you the lump sum. And in order to get 55% financing, by the way, you'd have to be probably in a major urban center in a detached home, and you'd probably have to be, over 80 years old. So in order to get that high of a loan to value, that would be the requirement. They do not adjust it after they approve and fund the mortgage initially. They do not readjust it over and over and over again. Once you've been given the mortgage, that's it. And so even if they give you a mortgage and the value and outstanding balance of the mortgage eventually exceeds the home value, they will not call the loan, they will not foreclose, and when it's sold, they will not ask the homeowner or the next of kin to pay up the difference and make up for the shortfall. So it's a nice thing that they've offered there, but again, they're quite conservative with their approach to it, and in order to make sure that the likelihood that the value exceeds the value of the mortgage exceeds the home value, it's quite minimal. Lenders wouldn't lend on it if they thought that they might lose money. So this is a just quick summary of what that looks like on a graph and a chart. You can see that the home equity is slowly increasing over time, and of course the interest is building up, and the reverse mortgage is also building up. But you can see that over time, actually better off than not. So the other option here is the reverse mortgage for Bank of Mom and Dad, helping adult kids. So in this case, Mr. and Ms. Patel are savvy Canadians who own a home, have an investment portfolio and a pension to support their retirement. Kids are fully grown, son's engaged and married or to be married, and the daughter just had their first baby, making them grandparents. The parents understand the difficulty of entering the real estate market for the son and the amount of money required to care for the new baby regarding their daughter. So they decide to be the Bank of Mom and Dad and give their kids a little bit of a helping hand. The financial advisor let them know that they can draw down on their investments, but at this time it wouldn't be a good idea. So they decided to access tax-free cash from their home using a reverse mortgage. And so really the reality is, although a reverse mortgage has a cost, remember too that depending on what the money is invested in right now, that you would still be in looking at a situation where if you pull it out of reverse mortgage, you have to pay an interest cost on it. If you pull it out of your investments, then there's also a investment return that you're losing out too. And so if you look at this, you have an investment return that you might be earning on your RSP or your RIF, or investing in stocks, in a number of different things, bonds or GICs or even cash. Or if you have equity in your home, in general, looking at a home value appreciation of, let's say, 4% per year, all of that has a cost to it. There's also the tax component. Taking out the RSP or RIF, 100% of it's taxed as income, so it really depends on the tax bracket. Selling stock could result in a capital gain of 25%. Bonds and GICs, 100% of it is taxable on the interest earned. Cash, if you're earning zero, then there's no cost on that. And for your personal residence, there is no tax on the home itself. Now, as the opportunity interest or cost on the amounts used, of course, these are basically the same as the others here, except for the home, and that's because the it depends on what exactly the interest rate is to borrow money on that. And so if you really look at the total cost here in each example, it may be actually cheaper in general to be borrowing money out of the home instead of borrowing and drawing out on some of these other investments. And I know it's more complicated than this, of course, because if you have money in RSPs or in a RIF, you do have to take it out at some point, so you do have to pay tax on it. But if you have to pay a large lump sum of tax by taking too much of it out at a certain juncture in time, instead of having a proper tax plan, then that can be more expensive. And so one of the benefits of getting a reverse mortgage or any mortgage for that matter in general is that the money is released to you tax free. Just a couple of questions here. So what is the current interest rate charge for a reverse mortgage? Right now, most of the lenders are somewhere in the high 8% or the low 9%, give or take, depending on the term that you're choosing. There's another question. Are you kind of locked in and at the mercy of the new interest rate after your first term, or are there big penalties for selling? So it really depends on the lender and the term that you choose. Typically, once you've been in a reverse mortgage for 3 to 5 years, then most of the time the penalties are either minimal or non-existent. You will find in general that as the mortgage balance continues to increase, if you maxed it out when you first took it, it may be difficult for you to eventually be able to redo that mortgage with a new lender, because you might now be exceeding the maximum loan to value that you'd be able to qualify for with a new lender. So you do need to be careful and make sure that you're okay with the fact that if you get a reverse mortgage, I usually suggest a reverse mortgage should be the last mortgage that you get, not the second last or third last mortgage that you get. So that's something to make sure that you consider here. Carolina asks, are you sending this video to attendees of this webinar? Yes, I am. And we also post it on YouTube as well. So you'll be able to rewatch it or send it out to any friends or family that want to watch it later. Another question by Gunther, do the interest rates move from the date you set up the reverse mortgage? So it depends on the term you choose. So you can take a 1-year term, which means that that rate stays the same for 1 year, and then it will renew in a year from now. You could also take a 5-year term, and then the rate is flat and stays the same for 5 whole years. And then at the expiration of the 5-year term, then you redo the mortgage. So it depends on the term that you choose, just like a regular mortgage. Here's another scenario using the open product. So there's a retired couple, they were age 72, and they realized that this is a great time to buy in a buyer's market to look at downsizing. So even though the rates are high, it's more advantageous to purchase at a lower price today than have a lower rate than a higher price later on. So they decided they want to jump the gun and look at buying something, and then they would wait to sell their property when the market was better. And in fact, I think that today's market, as of right now, might actually be one of those opportunities. It seems like the market might be a little bit quieter for the next 3 to 6 months. But the interest rates starting to fall and a lot of downward pressure projected on the interest rates, which I will talk a little bit about at the end of the presentation today as well. Buying before selling in this type of climate could be a really good fit, but a lot of people will not qualify to be able to do so. So the problem was they needed to maximize their funds that they can borrow in order to carry both properties at the same time, but don't want to debt service the hefty payments to be able to do so. And the solution was they had a $2.6 million property, and they found the perfect downsizing home for $1.1 million and needed to act right away. And so they got a chip open, and they were able to purchase the new home. They had no payments, and then they were able to sell and pay off the chip with no penalty when the time is right. And so in this case, just remember that this was the open mortgage product. And so because there's no penalty to break it early, the lender does charge a fee in order to compensate for the fact that there is no penalty to break it later on. In general, a lender does not like to give you an open mortgage that has no penalty unless there's some kind of fee attached to it, because otherwise they might give you the mortgage and then you pay it out in a month or two and they actually lost money on the loan. So generally speaking, they'll charge some kind of fee to do an open of some type. Gunther's asking, is there a fee to set up a reverse mortgage with your company or chip directly? Yes, so typically the lenders do have a setup fee. It's generally, depending on the situation, anywhere between about $8.95 and I think $13.95. It depends on the lender that we go through, and that's something that we're able to shop around and give you some different options that show what the setup fee is, show what the interest rates would be, the maximum loan amounts, and other features of the products like the penalties, etc. Another interesting way of looking at this is, the proactive downsizing. So we'll talk about the Cam family. So they had a home that was worth about 2.5 million, and it was paid off. They were 65 years old. They had one son that was 40 and one daughter who's 37, doctors and lawyers. And they only had about $200,000 in an investment account left. So they are very house rich and cash poor, which is very common in areas like Vancouver and Toronto, for instance. So the current situation was that they're in a cash shortfall position of $2,500 a month, and they're expecting an expense that would be coming up of about $25,000 to replace their roof and also maybe buy a new car. And so their option one was just to take money from their investments, and at $2,500 a month is about $30,000 a year. Plus, they need to take out $25,000 up front. And so their investment advisor advised them that somewhere between the age 72 and 77, depending on the interest gains that they get on their investment portfolio, their investment account would eventually be drained, and then they'd be back to needing to figure out something. And maybe that's downsizing, or maybe that's doing something else. Option two was to ask the kids to give them $1,000 a month as support. And then each kid is giving them $12,500 to help with the repairs and the placement. And the question was, can your children support you? Now, it's an interesting observation here because they've chosen an example where the son and daughter are doctors and lawyers. So I think option two is maybe the kids actually can support you. I feel like maybe they should have used an example where the kids weren't doctors and lawyers and probably actually could financially feasibly help in the situation, because then it makes it look like option two is not even on the table. However, I know that most people don't want to be asking their kids for help because they didn't want to downsize today, but they knew that eventually they would have to due to financial reasons and increasing living expenses if they didn't do something. And so one of the ways of doing this is you have a home worth $2.5 million, and they set up an amount where they can get up to $825,000 available to them on the equity release. And what they would do then is they bought an $800,000 free and clear rental condo with the money. And they're getting $3,500 a month in rental income on the property. And after the property taxes and strata fees, they're cash flowing $2,500 a month. And the non-compounding interest is deductible, which is really, really cool. So the interest cost on this mortgage is tax deductible. So now if they get to keep their home and that home is appreciating at 4%, when they're 75, so 10 years later, assuming a 4% annual appreciation, the home is being sold for $3.75 million, and the mortgage would go up from $825,000 up to about $2 million. So that's the effect of the reverse mortgage going up over time at a rate of 9%. So they would still net $1.75 million from selling their home in that point. And then the condo, when they're 75 years old, would go up from $800,000 up to $1.2 million as well. And so now they have a home worth or condo worth $1.2 million. They have $1.75 million of cash from selling their home that they've been living in for quite some time. They did collect $300,000 of net rent, but remember that they spent that. There was money that they came in and spent. So we haven't included it in the equity calculations here. And they still have all the money they had in investments, except it went from $200,000 and appreciated over 10 years up to $300,000. So this individual's wealth now has actually gone up to $3.25 million. So if they had to sell the home and just buy the condo, their net worth would not have been that great. Now, fast forward again, now they're 85 years old, and now the condo that is still free and clear is now worth $1.8 million, while now their net worth has again increased even further. So, if they wanted to or needed to, they could get up to $950,000 against that condo on another reverse mortgage if they wanted to or needed to for any reason. So the cool way of doing this is to buy something that they would downsize into at some point in the future, turn it into a rental, and they're generating rental income on it. So instead of selling to have cash to put into investments to generate an income, what they're doing is instead buying an investment property that is generating an income for them. And now you have two assets that are appreciating at 3 or 4% per year, or whatever the annual appreciation is for real estate over that 10-year period. Another option here too is you can get 3 times leverage instead of one rental property. And they could have bought three $700,000 pre-sale condos and put deposits down, and then they could have given one to each kid. They could have flipped it, flipped one, rented one, etc. Lots of different options there. That's a bit more of an aggressive move, I think, to buy 3 properties. But I mean, the key that I think they're articulating here is just that you can invest it into many different things. The lender doesn't really care too much about what you're investing in, as long as it's something that is expected to increase over time. Also, right sizing. So, if you own a home that's worth $2.5 million, well, you could also sell and buy a duplex that would generate some additional rental income. But another option is even just to go even higher and double the price, buy a fourplex. And in that case, if you sold your home that was worth $2.5 million and you needed some extra cash, perhaps you can get a $2.5 million reverse mortgage. And in this case, then now you can buy a fourplex that then is generating rental income on those 3 other units. And so maybe you're generating $10,000 to $12,000 per month for cash flow, or you could even use that cash flow to pay down the interest cost on the reverse mortgage as well if you didn't need all of it. So, a lot of different ways and options that you can get a bit creative with how to structure these. Now, one of the things that you might want to be looking at is just trying to figure out what your qualifications are. If you want to, it's actually very, very easy and quick. You can always email us at info@greenmortgageteam.ca, and we can go through that and give you an idea of, there's only a couple of questions we need to ask, and then we can let you know, yes, you qualify for this much with this lender, this much for this lender, here are the rates. And we can also send you over some charts and graphs that are created that go over what your home equity would look like over time. So it's a pretty cool way of being able to understand things. Now, I do want to go over the pros and cons on this a little bit. And a couple of things that I do want to talk about is that the pros of doing the reverse mortgage, there's no payments unless you choose to make payments in it. You get to stay in the home that you've been living in, and you get to qualify based on equity. So those are some of the key pros. And of course, there's some more creative uses that you can do as well. The cons on the flip side is the interest is higher than a regular mortgage. So that's one of the biggest downsides to this, is that it may not make sense for everybody. Also, the penalties can be higher in the first few years, depending on the term that you choose and the lender that you go with. And generally speaking, the maximum amount of financing you can get is 55%. And often it's less than that, by the way. Especially if you just turned 55, you might only get 15% or 16% of the home value. They're very conservative if you have a longer expected lifespan. And so that's something that you want to keep in mind. I do want to touch on a couple of other points here too. So there's a great question earlier about, well, what's the difference between just getting a line of credit versus a reverse mortgage? And the major key is that in general, the lenders with the line of credit still want you to be able to make the interest-only payments on the line of credit. However, if you can qualify for a line of credit and you can afford the minimum interest payments somehow, then a line of credit can be a better product simply because the interest cost is lower. So right now on line of credit, depending on the bank, most banks are prime plus 0.5. Right now, prime is 7.2, so that would be 7.7, and that is cheaper than a reverse mortgage is right now. Also more flexible. And in addition to that, we expect that over time next year, the interest rates will slowly start to decrease and that cost will decrease. And you could also use a line of credit in the same way where you can pull out and create a lump sum. What I find is that some people just get very stressed with the fact that they have to make a payment, even though technically you can take out the money off on the line of credit and put that cash in the bank account and then use that to service and make payments. It effectively acts like a reverse mortgage, but some people just get very stressed by the fact that they have to pay those payments. Also, an important key here is this something called right of survivorship. Right of survivorship means that if you get a line of credit and there's 2 applicants on it, and if one person passes away and now there's only 1 applicant left, that means that when that renewal comes up on that product or on that mortgage, the other individual now has to be able to qualify for the mortgage on their own, and many times they don't. And so in a reverse mortgage situation, it's fine. They don't re-qualify you, and you can continue to operate as such. I will say that there's a very cool kind of middle product that I would say. So there's the mortgage, there's a reverse mortgage, and then there's something in the middle. And with 2 different lenders, you can get a line of credit where, as long as you're not borrowing more than the limit on the line of credit, you don't actually need to make a payment on it. So the outstanding balance can continue to get added to the outstanding balance over time. So if the interest cost is $500, they would just add that to the outstanding balance, and then every single month the outstanding balance would increase. So I almost call it a pre-reverse mortgage, where you can get this product. The interest cost, because it's a line of credit, is cheaper than a reverse mortgage, but it gets to act like a reverse mortgage. Plus, you get all the bells and whistles of having a line of credit. So you can pull out money on it whenever you want. You can make a lump sum of whatever amount you want on it. You can pay off the whole thing with no penalties, etc. And so this is a nice middle ground, but you do have to qualify based on income, or that lender does have a net worth type of program you could qualify for as well. So it could be a unique middle ground there where you still have to qualify. You can still use it like a reverse mortgage, but it's not quite a reverse mortgage. And that could be something that could be attractive as well. And then before I wrap up and then open it up for some questions, some big news that's been happening over the last probably 2 weeks or so is that interest rates seem like they may have peaked. It seems like across the board, we're seeing a lot of changes with that. I'm just going to pull up the bond chart. And so so this is the beginning of October, the bond market and bond rates were somewhere around the 4.3 to 4.4% range. So, early to mid-October, they were quite high. Just in the last 30 days, the bonds have gone down 1%, which is a very large decrease. Now, looking back, the last time that we were at this level was in the middle of May. And back in the middle of May, we were still able to get interest rates somewhere in the low 5% range. So we were getting 3-year fixed rates at like 5.24% back then. Now we still haven't seen interest rates get down that low yet, but the trend is moving in that direction, especially with a really large movement just today, actually. And that's because the US Fed down in the US has started to say that they're expecting that interest rates will start to fall heading into next year. And I think the US Fed was predicting about 3 interest rate cuts, so 0.75% down in the US. And it was interesting to me that I was checking a chart here. And this chart specifically is looking at the implied interest rates for where the Bank of Canada is going to move. So it's a little bit more complicated to understand and read. But what they're suggesting here is that if you're looking at the basis points here, if you see the April announcement, they're expecting that the prime rate will be down by 35 basis points lower than it is today. It just means that there's a good chance that they think that the Bank of Canada is going to decrease the interest rate starting in April. So they don't give specific, hard examples of 0.25 or 0.5%. It's giving much more specific and accurate pictures of what the implied chance and implied interest rate would be at that time. But by going through this, you can see that they're expecting by the end of next year that we're about 1.25% lower than we are today. So almost 5 rate cuts have been completely priced in by the end of next year. What does that mean for anybody looking at borrowing money? It means that a variable rate is a very attractive spot to be right now. If you're looking at a variable rate that could drop by 1.25% by the end of next year, that's a very good place to be, as opposed to taking a longer term fixed rate mortgage. And we will see that right now, the bond market is reacting quicker than the Bank of Canada, and so you're going to see that fixed rates will be dropping first, and then eventually over time, the Bank of Canada will start to follow and start to drop interest rates later. But I wanted to point this out because it's very new news, and this information has been changing quite a bit, even just in the last 2 weeks. If we look at this chart, starting the very end of November. Interest rates were way up at bonds were up about 4.12%, and now they're down to 3.36. So a fairly significant drop of about 0.8%. It's quite a bit just in the last 2 weeks. So what does that mean for you? It means that interest rates are likely to be falling, and they already have started to fall, but they're a little bit slow. And in general, lenders don't like to drop interest rates too much during Christmas time. They don't want to get too busy and stress out their staff. But come January, I think that we're going to see further rate decreases. And frankly, we probably still will see some decreases in December, but maybe not on a complete dollar for dollar basis like what we're seeing in the bond market. So I hope this was informative. I'll open up for some questions. I know there's a lot of questions that people have about reverse mortgages. So if anybody has any questions I haven't been able to answer or haven't gotten to yet in the presentation, please pop that into the Q&A, and I'm happy to stay and chat, go over anything that anybody asks, and give you guys some feedback. And just keep in mind that if you have anything that comes up later, you can reach out to us at info@greenmortgageteam.ca. We're happy to prepare a quote for you on a reverse mortgage, give you some more feedback or information, and also compare a reverse mortgage versus a standard mortgage, and maybe even versus a line of credit with a lender that can operate more similarly to a reverse mortgage as well. So any questions? Thanks, Fermin. It's good to see you. Long time. You guys are taking it easy on me. Well, if you don't have any questions, then I'll wrap up the presentation. And it was great to see everyone here. I'm looking forward to seeing you guys again soon, and have a wonderful holiday season. And we'll be getting back to you guys with our presentation starting up again in January. Again, the first Wednesday of the month there. So looking forward to it. Thanks so much, everyone. Have a great night. Happy holidays, and we'll talk soon.